some sources, the federal government is trying to increase the 2016 budget to about 8 trillion naira, and that may require some sort of deficit financing. So if the CBN does not relax policies on exchange rates, that means the domestic bond market would have to completely shoulder the burden of financing the government deficit. So if that comes into place, we should see it probably rise as a result of that. So that's why I said that right now the short to medium term outlook for policy, macroeconomic policy, both fiscal and monetary, they are not quite clear. And so that may in a way affect the level of activity and the sentiments of investors in the bond market. So may try and stay cautious while awaiting further policy direction. To know the position to take. Why some may probably start taking profits right now and just hold on and wait to see what the fiscal policy direction will be in 2016.
Tola, I was about to ask the question. If I'm investing in bonds right now and I'm looking at about 8%, 10.5% on average, I started the year around 14, 15%. Do you think I should hold on a little bit to that portfolio, hoping that somehow by 2016, as we expect government fiscal appropriation to go as high as 8 trillion, the DMO, the debt office will come to the market, rate will go back to 14, 15%, perhaps 17% by some forecasts. That's not good for the economy. But however, some folks have to make money.
Yeah, definitely, Bossing. Regarding your question, how would you play in the market right now? That depends on your strategy. If you are an active trader, right now you perhaps want to hold on because if you buy now at the present 8% yield and yields go as high as 14% next year or 10% next year, you're going to suffer some value depreciation or value impairment. However, if you are more of a passive investor and you just want to hold to maturity, you can still buy in at 6% yield. I mean, if you keep your money somewhere else now, the time value of money will probably erode it before 2016 runs out and we start seeing fiscal policy taking shape. So, depending on your strategy, basically, if you are an active investor, I would say that probably hold on, see where these will go next year, not taking position. But if you're a longer term investor and you want to go to maturity, these are still attractive for you. I mean, the points are quite fantastic. 10% across the longer instruments. So, you can take the position, Bossing.
Either ways, treasuries and bonds, bills and bonds are still far better than taking position in equities at this point in time.
Yeah, you're quite correct on that. The sentiment in the equities market are quite low, driven by two major factors. Earnings are poor due to the macroeconomic backdrop. We have seen a decline in fiscal spending. We have seen a weakening of consumer sentiment, and we have seen earnings drop significantly as at 9 months results. And the second factor which is affecting foreign investor sentiment, which is the uncertainty in the foreign exchange market. So the outlook for the equities market right now is quite poor, and that may further probably inform some investors to start taking advantage of opportunities in the fixed income market. However, with the significant drop in yield in the fixed income market, informed by the CBN decision to cut the monetary policy rates and slash the CRR last week, and also to stop mopping up liquidity in the market, in the financial system rather, that may also, in a way, make the outlook for the fixed income market not quite clear yet. So, really, if you want to invest in equities, there are uncertainties. If you want to do fixed income, there are uncertainties. Two things will inform your decision: what's your risk appetite and what's your holding period.
Oh, okay, let's step a little bit away for about a minute or two into the FX market. When we talk about the central bank being so tight-fisted as far as foreign exchange market is concerned since sometime around the middle of the year, when you analysts talk about relaxing that tight FX market, what specifically are you guys looking for? Naira rebalancing, devaluation, what?
There are two things analysts are expecting. Of course, most analysts would like the restriction on foreign exchange access to reduce significantly because it's really hurting many businesses. I mean, net export contributes more than 30% to GDP by expenditure. So that means that trade-related activities are quite important. It's quite an important driver of the economy, and of course the manufacturing sector as well. Right now, the economy is not quite independent yet of importing for domestic manufacturing. So as long as domestic manufacturers will continue to rely on import of raw materials for their production, they will continue to need access to foreign exchange. And if you don't release this to them, they're going to cut back on households, they're going to sack more workers, they're going to increase their prices. So we start seeing inflationary pressure building in. So we want lesser restrictions for foreign exchange, and lesser restrictions would mean that the naira will be naturally depreciate because at the level it is holding right now in the interbank market, many believe it is not appropriately priced. So reducing the restriction will naturally lead to a depreciation in the exchange rate. However, there are two sides to it. If we see a depreciation, government revenue nominally is going to increase. We start saying, let's say, increase in fiscal spending, consumer sentiment may increase. Of course, we see some increase in cost. This is the higher production cost. However, since most of the position is already priced in already, with most people going to the prime market to get their foreign exchange, I mean, it may not be too significant. But holding on to this price-listed method, with number one, government revenue will continue to be very, very low, nominally. And number two, the production activities will also continue to be impacted significantly by restrictions to foreign exchange access.
Okay. Omotola Abimbola, thank you very much for that very lengthy insight into the markets for us this Tuesday. Part of that's a lot of forward-looking conversation as to what lies in the days, weeks ahead and into the new year. Thank you very much, Omotola Abimbola, investment research analyst at Afrinvest. And that's about all for today on Business Morning. We thank you for watching, everyone. I'll see you next time. Do have a great day.